Hi there, this is Bruce at Fleet Capital Management. It's Friday afternoon. It's about 2 p.m. on the West Coast, May 5th, 2023, Cinco de Mayo. Want to take a look at what happened this week. It was a very rocky week, but it ended real strong. And see if we can decipher what's going to happen potentially next week. What do the markets look like? Are they telling us anything? And then I'm going to show you another trend indicator that I've just added. It's very simple, but I think it will assure us that we never participate in another bear market, which is obviously the goal. So the video presentation is intended for educational purposes only. The discussion of any security is not a recommendation to purchase or sell the security. Please subscribe to this YouTube channel. Please click the thumbs up if you enjoy the content, or thumbs down if you don't. That'll let me know the type of things you would like me to record. Also, if you have any questions at all, always feel free to reach out to me, Bruce at fleetcapitalmanagement.com. Homepage of our website, 2 buttons. This will take you to the most recent weekly video, and this is how you will schedule a Zoom meeting with me so we can discuss whatever's on your mind and take a look at your investment portfolio. So, as always, let's start over in our little matrix, which is just kind of a simplified way to look at the trends. I had some clients say that this made it much easier to see trends rather than the charts, but they're both really the same. So for group one, which is a little bit faster, a little bit more aggressive, we do have some down days on something called the Hull ribbon, which is very responsive, but we're still clearly up on very short 8 moving average over the 21-day moving average. So we have kind of a split in here, which makes sense for what we've seen in the market, but nothing terrible. The more important is the longer term trends. This is the weekly. This is what I use primarily for group 2. The Hull is still up on the weekly, and the go no go chart is up on the weekly. I also use, and I will show you, the 20-day, 50-day, and 200-day moving average. This is the D means daily. MA is moving averages, and a bull market configuration is the 20 over the 50 and the 50 over the 200, and we are there. What I've added is this side. This is a weekly, and it is a 10-week over a 20-week. EMA just means it's a form of a moving average, just a little bit faster. It's called an exponential moving average. There is really no caution sign. You're either bullish or you're bearish, and we are bullish. And I'm going to show you what this means, and this should keep us out of any bear market in the future. So let's go over there right now and take a look at that. Let me see which chart I have it on. I have it on this one. So here's the weekly over here. Actually, I'll get rid of the daily. This is just a weekly movie. This is a weekly of the S&P 500. Each bar is 1 week. So this is this week, and it closed today. It closes every Friday. If it were Thursday, it just means that it's not closed yet. It wouldn't have that dash to the right. And you can see it was a little bit of a down week. But what I really wanted to show you was I was studying this chart. I was talking to a friend, an acquaintance in Great Britain who is a professional trader. And we were talking about long-term moving averages being really significant. This is the last major bull market. This was back in 2020, I believe, 2020 into 2021. And you can see that green line is over here. It's the 10-day moving average. The red line, excuse me, that's the 10-week moving average. And the red line is the 20-week EMA, or exponential moving average. And you can see that no matter what the market does, when the 10 is above the 20 on a weekly basis, we are still considered in a bull market. So this is where the bear market, this is right around January 1st of 2022. The market started to go down. No one knows if it's going to be a bear market or not. But look at what happened. The 10-week crossed the 20-week right here. Consequently, we got a no-go actually the next week from that symbol, but we're just looking at the 10-week cross the 20-week, and it stayed the 20-week, which is the red, stayed above the 10-week, which is the faster, which is, and it just stayed, you can see that the 20 is over the 10, or you can say that the 10 is below the 20, which is where the cross was. But that stayed in that configuration all the way until right here, which was January 23rd of 2023, when based on this analysis alone, just the 10 and the 20-week EMAs, if we would have followed this, we would have avoided the entirety of the bull market. We will do that going forward because I think this is a slower moving but very reliable weekly moving average. Okay, so it got us out of the market right here and got us back into the market right about here. So what I've done is I've added that to my weekly analysis, since that's a weekly moving average. And if this ever crosses to where it goes bearish, which means the 10 is below the 20, we will not buy a single security, and we will aggressively tighten our stops on any securities that we own. Eventually, we'll get stopped out of those securities if it continues in the bull market. So this is very similar to the 50 crossing below the 200, but this is a little bit smoother. So now we have both of them to look at, and I think between the two, it's going to be extremely helpful. What we don't want is we don't want to participate. We don't want to be long anything. Excuse me about that. In a bear market, what we want to do is inverse securities in a bear market. So anyway, I wanted to show you that. I'm very happy with that new addition. I think it's going to be really extraordinary for us as we go forward. Okay, so let me find my charts. There are my charts. So that's what I wanted to show you. That was the 10 to 20, and that signal right there will keep us out of any future bear market. So now let's just go to our regular daily S&P 500. Each bar is one day. Here was today. Today was a fabulous day. And what I like to do now, because actually I had some clients say that it was great when I did this, is I don't have any indicators on here, nothing. This line up here just means that's the price that it closed at. That's all that line is. So I have no indicators on here. And we're going to kind of build our indicators and see, you know, once your eye is trained to technical analysis, you can kind of see where the indicators would fall. But the indicators definitely do help us. So are we in an uptrend? Are we in a downtrend? Are we in a sideways trend? Sideways is probably a bit of the right answer, but let's take a look. So if we add the super trend on, these are those ATR dots that I use all the time. We're down just shy below the ATR. We were there once before. So these things will flip once in a while. So it's not the perfect indicator. It's just a very good indicator. And that helps us a little bit. And then if I add the Hull moving average, which is the ribbon, this is something that was created by a gentleman. I can't think of his first name, but his last name was Hull. And it's a very responsive moving average that tries to find tops and bottoms based on different analysis than the super trend is using. Super trend is using ATR, which is average true range. Hull is using moving averages, but with a smoothing technique. So what we can see here is the Hull is red. That's still down, and the super trend's down, but we're really close. We're not very far away. So I'm not seeing anything terrible on here. If we add our moving averages, which are always important, the blue is the 20, which is above the 50. When the blue is above the gold, if you will, we're in a technical bull market. And especially when the 50 is above the 200, okay? But let's assume that the 50 is going to be above the 200 for the foreseeable future, which is what I suspect. We'll just be in a bull market. So then what happens is if the 20, the blue, crosses the 50, it just means we're in a correction. So we can be in a long-term bull market and be in a correction at the same time. And that's what that would mean. And when we're in a correction, we're probably not buying any new stocks. We're just waiting. We're waiting to see how far that correction will take us. Will the correction turn into a bear market? Usually it doesn't, but it could. And then to look at the strength of when I am buying things, let me go to that moving average again. bear with me, I'm going to add the 8-day, which is very short. I use this for trading purposes. If the 8 is above and I'm looking at a specific stock, I need the 8 to be above the 20, because that just tells me that short term we've got some good strong momentum, and we want that when we buy stocks. We buy momentum stocks. We buy high quality stocks that have momentum. That's what we buy, and I'll show you that in just a second. I'm going to take the ribbon off. So that shows me, even though we're down here a little bit, you can see that using this analysis, we're still clearly doing fine. So what you do is you layer different styles of analysis that are using different underlying math to calculate, and you kind of get a feel for how things are going. If that 20 or even the 8 crossed below and we were under super trend and we were under Hull, okay, then I start to worry, but we're not right now. So I think we're fine. Let me add some trend lines. So this is a strong trend line. The blue and the pink or whatever color that is kind of a strong trend line. They're fairly short trend lines, and then you can see some really faint lines. This is a weak, anything that is this faint is a weak downtrending line, and then you can see it broke it. But it's nice for me to see those as well, to see when we break trend lines. And right now, our price, which is right there, is clearly above that upsloping trend line. So I'm pretty happy with that. Let's add one more piece. Okay, so these are order blocks. This is where institutions have orders in the system right now for the S&P 500. So this is adjusted for every individual stock. But what I'm seeing is that price, even though it was weak, it came right down into this order block and it started to kind of suck up some shares. That's what that little symbol means, and went right back up. That little symbol, it generally means we're about to reverse. So like here's one on top. It was sucking up some orders and then it fell. So we use all of these things to help us gauge the market. And the market right now looks to me to be mixed, but it also looks to me to be in an uptrend. If I were to draw another trend line, which is not on here, I would probably go from here to here. That's an uptrend. So that was already picked out by this blue. Actually, it's already on there. Perfect. So we're seeing that the trend lines are working just fine. They're picking those up. Let me get rid of that line. I'll show you something else. We could even do a trend line from the bottom of the hull to the bottom of the hull. If we did that and decided to use that as another gauge, let's see why that didn't work and make it work. So there we go. From bottom of hull to bottom of hull, there's another indication that we're in an uptrend. So almost every way that we look at it, the market's in an uptrend, even though the last couple of weeks have been kind of shaky. We could do one from here. Watch this. We could do, was this a higher high? Yeah, it was. Let's see if I can draw that. There we go. We had a higher high there. We had just a slight higher high here. Oops. Just a slight higher high here. But in technical analysis, this is the stuff we're looking for. We're looking for clues. And what I really want to see is I want to see the price break this high. That would be a nice breakout. Then I want to see the price break this high. That would be a nice breakout. So all of those things would, I hope this helps. I hope you enjoy this, but all of these things help us get a feel for how the market overall is doing, regardless of what it's doing on a daily basis. Because on a daily basis, the market can make us crazy. We need to look a little bit longer term there. And I think I pointed out to you last week that these gold bars down here, which happened to be when the S&P was coming down to this little channel down here, this means there was institutional activity taking place. And look at what happened. Institutions decided they wanted to push the price back up. Market came down. We're still in an overall uptrend, but look at what happened. Institutions came in to the gold bars and started to push the price back up. So we can see institutions behind the scenes and what they're doing. If we were in some securities or in the market right here, and we're starting to say, wow, what is going on? Is this market going lower? I've got a red hull, I've got a red super trend, I've got, all kinds of red. If I see institutions come in, I have a lot more security in my mind, feeling like the market's going to go back up. So that's just another piece of technical analysis that I wanted to show you. There's a lot of stuff on there. And then I use what's called Elder Impulse to color the bars, and it just shows me on a daily basis what's happening in the market. So I think the market looks good. I think our stocks look good for the most part. Let's go to a couple of stocks. Let me show you this, and not that. That's the wrong one. Let's go to this one, and let me make sure it's somewhat up to date. So here's our current stocks that are in FCM portfolios. And you can see we are outperforming the market by a pretty good margin right now. Sometimes we will, sometimes we won't, but we've been outperforming for quite some time. And take a look at a couple of these things. Let me show you. I wonder if this will work. Bear with me. So Builder stock. Builder stock is up 19.3%. Not a bad rate of return. Massey is up 13%, but we've already closed it once at 11%. So if you add those two together, we're up 25% on Massey. Microsoft, for those who are holding it, this is just since January 1st, is up almost 30%. NVIDIA, since January 1st, is up 100% since January 1st. I had held NVIDIA and Microsoft were two kind of long-term holdings that I was trying. They beat us up in the bear market. We were down as much as about 50% on both of them. And I had some terribly difficult decisions to make, especially with NVIDIA. And for taxable accounts, which were only a few accounts that held NVIDIA, I decided to sell it because at least we would get the tax benefit of that loss. For the retirement accounts, I made a very difficult decision that some clients thought I was absolutely out of my mind. Some got really mad, and I understand. And that decision has worked. We're now up 100% since January 1st. I think for the people that held it, we were down 50%. We're now down about 10%, something like that. So decisions have to be made every day, and those are the decisions I make. Here's another one, SMCI. SMCI, we've only been in it for a couple of months. We're up 64%. So we've got some real strong hitters, some really strong stocks in here, and we're just going to keep buying stocks and keep trying to beat the market and keep doing what we're doing. What we haven't had yet, the only thing we haven't had yet, is an explosion to the upside. Like we've already talked about ad nauseum, it looks like the trend is up, but we haven't had that explosive breakout. Let me tell you why I believe, this is not technical analysis, but why I believe we're close to it. If I were a betting man, I would say that the 25-point increase that the Fed did just on Wednesday, it's highly probable that that's going to be the last increase that we're going to see. Will we see one more? It's possible, and it always depends on what happens. If we get some more bank failures, if we get some more high inflation numbers, I mean, they're looking at numbers every day. But on a general basis, my gut is saying we're done. We're done with rate increases. Could that be a catalyst to finally break out this market and really push us higher? Yeah, it could. There are rumors in news that Vladimir Putin, we suspect he has cancer. We suspect he's in his last phase of his life. I don't wish anyone death, but I will say he won't be missed. If he were to die, what would happen to the market? But let's say he lives. There are some rumors in the news that he is prepping Russians to the fact that they're going to lose the war in Ukraine. And if they were to pull out of Ukraine, what would that do to the markets? So we've got some catalysts ahead that could be significant. We're not looking for this. This we're not looking for. We've had some great stocks during this time that have made really good money. They're helping us. They're pulling us forward, although not a lot, but they're pulling us forward. The breakout is what we're waiting for. And that's where we're going to get the significant jump. Let me just show you something. Let me squish this down a little bit. The more I squish this down, the more it looks like it's going sideways, right? We need to break this high. This was last August. And we need to break that high. I can put a line on here and show you where it is. So we need the markets. It's not that far away, but we need the markets to break that August high. If we do, the sky's the limit. Then we're going to be in that breakout mode that I keep telling you about and that we're keep trying to see when it's going to come. We're not that terribly far away, but we're a little bit. So we need to get that done. If we get that done, we're going to have that breakout. I think we have some things on the horizon that could cause a breakout, but that's why things have felt like they're going nowhere. We go up and we go down. It's because of this. But I'm telling you that it's coming, and that even this looks like it's starting to build a pattern. The last thing I'll say about this is, for those of you who were with me in 2015, which is the majority of you, 2015, the whole year went sideways. And I had one client write me, and she said, if I hear you say the word sideways one more time, I'm going to scream. But that's what it was. And sideways is, remember, it's called a consolidation. Markets can go up, markets can go down, markets can go sideways. The longer the consolidation, the more powerful the breakout is, whether it breaks out to the upside or the downside. Everything leads us to believe that this is going to break out to the upside. Every piece of technical analysis says it's going to break to the upside. Could it break to the downside? Sure, it could. So during these consolidations, don't hate the market as much, because consolidations are important as well, especially upward tilting consolidations. That means there's still a bias on the upside. And hopefully we're going to see that breakout soon, and you're going to see some extraordinary numbers. I want to see them too. But the bottom line is, we've got a lot of stocks that are knocking the ball right out of the park. We're going to hopefully add some more. Our biggest loser is down 16.6%. Why am I still in it? Well, I'm still in it because every ranking from every Wall Street analyst and every quantitative analysis is still very, very strong. I'm giving it, when something is that strong, I give it more leeway. Because what we want is these things to pop. That happened with SMCI. We were down a fair amount. Everything I looked at was strong. I wanted to give it room. I'm glad I did, because we're up 64%. Let's see when we went into that investment. We went into that on February 6th. So we haven't even been in it the entire year. February 6th and up 65% is really awesome. So anyway, that's a story. I hope this helps. Our stocks are beating the market. We're doing a pretty good job. We just haven't had the market strength on our side. That's what we're waiting for. That's the next step. And we will keep managing within this and doing the best we can, and waiting that make sure we're positioned in high quality stocks. So when that breakout comes, we are participating in a big way. So that's a story. Have a wonderful weekend. I hope you enjoyed this. I hope it helps. If you would give me feedback on it, that would help me know what it is I should be recording for you. I do these for you, not for me. So that's a story. Have a wonderful weekend, and we will see each other Monday morning. Bye-bye.